All right, recording started on OBS. Let me hop into Disk and share my screen. So today's lesson is swing structure. Who here thinks and also everyone can come off mute during these lessons because it's way easier for me to talk with you guys than engage with this chat here kind of in the right corner because I'm going to be on my trading view, so I won't be able to actually flip back and forth. So when we're talking, just feel free to come off mute and just talk. So who here knows what swing structure is and would like to take a stab at it before I start the lesson? I just want to see where we're at. Anyone? Any hands? Yeah, absolutely. Yes, that's the best place to start. So, Joe, can you explain to everyone what you view as a swing, as a valid swing, or what you think of swing structure when I say that? That's okay. That's okay. Talking and regurgitating is the best way to kind of reinforce your learning. Trust me. Beautiful. That's the single best way to capture what swing structure is. Good job, Joe. That's amazing. So, Joe just said it in the simplest way possible. And that's exactly where we're going to start today. A swing, right? Swing structure is defined by a 3-candle pattern. So it's a 3-bar pattern that's often called a topping pattern, and you'll often see the same thing on the bottom as a bottoming pattern. Essentially, this 3-bar pattern known as a swing, which encompasses this kind of price action in a chart, is exceptionally important when we're applying smart money concepts, so ICT concepts. And the reason why is because structure is what we're going to use on timeframes to determine if there has been institutional endorsement. Meaning, you'll often hear me say a market structure shift or a break of structure, or we're looking to see how we interact with a liquidity pool, right? If we close below it, if we close above it, it's all going to be in relation to what we're going to define now as swing structure, or these 3-bar patterns. Now, importantly, when we're looking at swing structure, does the color of the candle matter? Joe, why don't you answer that? Does this have to be a different color than this candle? So say, let's make all of our up close candles green and all of our down close candles red. What qualifies a swing? Do they have to? It doesn't matter, right? So all I'm going to tell you is that this is something that's often confused. For a valid swing to be put in, I want you to think of each candle, right, up and down, as kind of like a paintbrush. And I've done this activity with some of my other students. And what we're going to do is we're going to start painting each candle up and down and up and down. And every time we see a local, right, low, or a local high, that is going to count as a swing point. So sometimes I've heard people teach this crazy. They're like, a swing has to look like this, right? It has to be a down close candle and then an up close candle on either side. It has to be a difference between these 3 candles. It's not actually true, because is this a valid swing, guys? Yes or no? If it's on a chart. Yes. Is this a valid swing? Yeah, why not, right? Is this a valid swing? This is a valid swing? Is this a swing high? Is this valid? This swing is not a valid swing high yet, because we could keep doing something like this. Okay? So a swing pattern, right, has to put in a local low or high. And a local low or high, I'm going to define to you in a better way. So as opposed to just looking at the candle of the colors, right, in the 3-bar pattern, I want you to think of the candles in a 2-bar pattern and just say that every high needs to have a change in the characteristic of the candle for it to be a high, and it has to then also put in a swing low to the right. That's a confusing statement. So I'm going to show you what this looks like on the chart. So is this, would you call this a valid high? AJ, having done kind of a little bit more with you, would you call this a valid high? And tell me why you wouldn't call it a valid high. Yes. So the first takeaway for this lesson is that a swing high can only be qualified by an accompanying, by an adjacent, you could say, swing low, and vice versa. Now, why is that important? Because if the state of delivery of candles continues to be bullish, for example, in this case, right? Think about a paintbrush and say there's more price action here. Say we're doing something like this, coming up and then down and then up, and then here we come down. Is this next set of candles all up, or is there a local low put in? PMA. In this set of 3 candles, say it looks like this. We don't, maybe there's wicks on these. It's all up, right? Yeah, it's all up. So this is not a swing high, but where is the swing low? Right here. So do you guys see how often the color of candles that people teach for swing structure is kind of back-assed? Like, it doesn't really make sense, right? Yes. Yes. Because in order to qualify, so the better way of thinking in terms of color, right, PMA, would just be a swing high can only be qualified by an adjacent swing low and vice versa. So a swing low, don't think about the color of the candle per se. I mean, of course, there's going to have to be a change in the color of the candle. Think about the delivery state of that area. So in this area right here, are we putting in a local low? It, okay, that's perfect. Now we're getting into that's a great statement. So let's touch on that in 1 minute. Just a quick question: are we putting in a local low here? Say, for example, this looks like this, right after. Okay, that's a really awesome point you had. So what is this low? Also, could we say that this is a local low and this is a high? So the difference between this low and this low is what? Absolutely. So now we're going to have another definition just based on, and we're going to do this in a real chart, guys. I'm just showing it to you in this kind of schematic because, it's hypothetical. We're going to call this here, in this chart, we're going to name this our long-term low. So this is like the daily chart, right? This is now going to be our long-term low. And this here is going to be, what do you think I'm going to call this? Yeah, intermediate or short-term low. Okay, here's a question. When we get a break of structure, right, to the downside, which low being breached do you think is going to be a higher quality break of structure in terms of a reversal? Of course, right? Long-term low. So this pattern right in here represents 2 swing states. We may have a short-term low that's broken, then we may retrace, followed by a long-term low that's broken, okay? This is going to be such an important concept when we're looking at qualifying our trades and seeing what has a higher chance of being probable when we're executing in them. So you guys understand that concept. Let's get on to the charts and look at that, what that actually looks like. So the next concept I'm going to teach. So we've got 2 concepts so far, right? The first concept is a swing high or swing low needs to be qualified by an adjacent, swing point. There has to be a change in the state of that area. Okay, the next thing is, what do you guys think? Do we define a swing high by the wicks or the bodies? Is this the swing high here, or is this the swing high here? Wick. Why would you say wick? Yeah, Yeah, there's orders booked in that wick, right? Yeah. So yeah, no, that's the perfect response. This represents a lower time frame body. Maybe that's a better response. So a higher time frame wick is a lower time frame body. So if we have a 5-minute wick, right? If I can convince you that if I zoomed in on this wick right here, on a lower time frame, you would see complete bodies, then that qualifies the statement, right? There we go. You see the bodies right here. That qualifies the statement that wicks actually do contain price action and therefore should be considered as swing points. Okay, so let's write that down. We consider wicks to be a part of swing structure. Awesome. Everyone has that written down. The next question I have is then, if we want to classify a break of structure, do you think we want a closure above the body or above the wick? Absolutely. So what's the answer? If we're going to qualify this as a break of structure, do we want, right here, do we want a body to close over this high or do we want a wick to close over this high? Okay. So now we're getting a little bit of difference between what we just said and what we classify as a break of structure. So we're going to write down in our notes, we consider wicks to be a part of swing structure. We, however, do not consider wicks to qualify a break of structure. I'm going to say that again. Wicks are valid swing highs and lows. A break of structure requires a body. Can anyone tell me why these two statements, which seem to be in opposition of each other, make sense from the perspective of a smart money trader? Can anyone take a guess? If wicks are considered part of swing structure, then why can't we just get a wick closing through here to be a break of structure? Can someone try and take a guess at that? Oh, I like that. I like that word. Wicks can be manipulated. I heard a couple of ideas. I'm gonna write them down. Yeah, keep going. What'd you say? Ah. Oh, this is great. Someone else. Keep adding things that you think. Why do you think that wicks closing above wicks wouldn't be valid? Someone else give me a thought. I like both of these right here. They're both amazing. Give me another one. There's one more I can think of that's a very good reason. And ICT traders hate to talk about this. It starts with a V. It's a word that starts with V. That's yep, that okay, liquidity stop rates. Yep, that's what it's not even an ICT concept. It's the dirty V word that every ICT trader says is manipulated. Yeah, volume. Wicks have more or less volume. Strict Strictly speaking, the wick of a candle contains more or less volume of that candle. Less, strictly less, right? Wicks contain less volume of the candle than bodies. Does anyone know why that's true? The wick is yes, exactly. Wicks are actually an inefficient delivery of price, and that's why you don't see a body close there. So, for example, this wick is really on a lower time frame, telling you there was a buy side delivery and then an immediate rebalance to the sell side. In here, do you think with an immediate rebalance, there's more or less orders being fulfilled on either side, buys and sells? If so, here's look at what this is on the 1 minute. In this piece of price action right here, these two candles, right? Is there more or less orders being filled than in the rest of this 5-minute candle, which is the next three candles? What do you guys think? Less. You're absolutely right, because price leaves that area very quickly. It doesn't stay long in this area, does it? Right? It fills the buy orders and immediately fills the sell orders. Then in this rest of the 5-minute candle, we move back and forth, right? You can see that. We have wicks in this 1 minute, meaning we move back and forth, right? So in the 5-minute chart, a wick has less volume. Have you guys heard that before? That wicks don't contain the same volume as bodies? Or is that a new? Okay, so maybe we can prove that. Yeah, maybe we can prove that with a fixed range volume profile. Why is it not showing me? Ah, yes. Do you see how this is perfect for me. Yeah, you're right. There is volume in this area. Do you see how this upper extremity of the wick has the least volume? And then the most volume is contained right in here at this point? Do you guys see that in this fixed volume profile? This is the kind of logic I'm trying to convince you of, is that oftentimes in these wick extremities, there's very little volume, okay? Is that enough of a proof for that statement? Okay. Okay. So there's 3 reasons, and one of them is, 2 of them are not are one of them is not ICT based, 2 of them are completely ICT based. So I like the first 2 statements a lot. Wicks can be manipulation. Wicks can take liquidity or sweep liquidity and be stop trades. So now, why I always tell my students that we will only consider break of structure to be bodies, right, is because we want to take the highest probability trades. And we'll only know if a candle is sweeping liquidity after it closes. So once we see the closure of a candle on whatever time frame, that is the only way we can validate, right, that it didn't sweep liquidity to move lower. Does that make sense? Once we see the body closure, or else we have no idea. Do you want me to show you what a counterexample of some people who consider wicks to be a break of structure would be? Do you see this candle right here, right? Do you see how this wick closes below this swing low? Or let's actually look at another swing low. Maybe we can look at a higher time frame chart, because that's where it's going to be more impactful. Actually, this is perfect. Right, what would we call this right here? Being ICT traders. This you would call you would call this a break of structure? Yes, yeah, totally. We would call this a liquidity sweep, right? In hindsight, we can see it's a total liquidity sweep, right? In hindsight, right? But if we didn't have hindsight on our side, and we were only looking at swing structure, the reason why I teach you that we're going to consider only bodies is because, do you think that some people would think this looks bearish? Yeah, right? Yeah, totally. Guys, this looks kind of bearish, right? But the reason why we're not going to qualify this as a break of structure to the downside is because we do not get a candle body closure through this level. So this swing point, which now we're tying in swing structure again, this swing, has it been invalidated or not, guys? Yes or no? Right here. No. This has not been an invalidation of the swing point. Critical part of this lecture is understanding the invalidation or validation of swing structure. We need to see a closure of a candle through the wick for it to be a validating or invalidation of a swing point. That's the next thing you're going to put in your notes. Yes, absolutely. If what? If we put in a what candle beside it? Yes, so let's keep playing. Good eye, Gomez. There you go. Boom. You are not going to get baited by this because you understand, right? Structure. This is not a break of structure. This is a swing low that is being maintained. this swing structure is not being invalidated in our books. So when people say, are we closing through the swing low? We're not. It's not a break of structure, and we expect this to be a reversal. Absolutely vital. I mean, this is basics, but I'm starting from the beginning because so you got to start somewhere. Do you notice the difference between this interaction here and this interaction here? What happens here? Look at this candle. It closes back into the range, right? Do you see how this candle doesn't close through? The next candle shows us what? The bearish displacement, right? Only once we close through this low do we consider this to be a market structure shift and this to be the invalidation of this swing low. As you can see, once we close through with a bearish candle, we deliver the sell side. Okay, this is going to be important for determining what a break of structure looks like. That's the basics. This is something that one of my students last week was hung up on whether or not a wick qualified as a break of structure or a body. What's the answer to that now, everyone? What is a break of structure defined as? Let's define it in our notes. A market structure shift or break of structure is defined as, everyone write this down, a candle body closing through the wick of the swing structure. A candle body closing through the wick of a swing structure. That is a break of structure or a market structure shift. Do you guys see another example of where this definition really helps us in determining bias? It's right in this area right here. Do you guys see it? Yeah. Look at this. We have no way of qualifying, right, if we have broken structure until the candle closes. So one of my students earlier in the week entered on a setup similar to this, but they didn't wait for a break of structure. He who shall not be named, his name might be Falcon, but he's learned and he's journaled it. Sorry, Falcon. I'm just joking with you. So Falcon, and it's fine. We learn from our mistakes. There's nothing to be ashamed of, guys. Falcon didn't wait for a break of structure on a 5-minute and ended up taking a trade similar to this, where the candle ended up doing what? It closed back in the range, right, Falcon? And then what happened quickly after that? The trade was invalidated, right? So when we look for a break of structure, we have to recognize that when we're qualifying swing structure, we are only going to be looking for a candle body closing through a candle wick. Or else, what is this? What is this? Everyone tell me what this is all at once. What is this right here? This piece of price action? Liquidity sweep, raid, yeah. Stop hunt, liquidity sweep, raid. But would you know, yeah, purge. Would you know that until the candle closes? Yes or no? No, because what's so important that so many people don't recognize is that in the last 5 seconds of a 5-minute candle, this body could just do this, right? That's why we're going to write down another note. When evaluating swing structure, we will always wait for the candle body to close. Always. Because the only way we can validate a break of swing structure or a purge of a swing high is going to be when the candle body closes. Meaning, I have a question, will you guys ever enter a trade, right? Before, or will you guys ever call this a market structure shift now before a candle body close? Will you ever say that anymore? Yes or no? Also, equally speaking, would you invalidate a trade? So say, for example, you enter here for some model you have, right? Where is going to be your stop loss? Is it going to be a close below the low, or is it going to be a wick through the low? Which one? It should be close. So now, this is where people have different risk management profiles. But the way I trade personally, XYJ trades, is a trade idea is only invalidated on a candle closure through swing structure. Now, the reason why this is so important, I'm spending so much time kind of on this, is it might seem obvious, but say you have a fair value gap right here, right? And say this is a fair value gap or this is a fair value gap up here. And you enter this trade. I mean, obviously you wouldn't because there's no setup here, but say you did. Where's the invalidation of this fair value gap? Someone tell me. Yep. Well, what's the invalidation? Where do I know if I'm wrong? Say I shorted this fair value gap. Where would I know I'm wrong? Yes. So the way ICT teaches fair value gaps is the invalidation of a fair value gap is the swing high of the first candle. The way I'm going to teach you fair value gaps is this. And this again has to do with swing structure. So the invalidation of a fair value gap is a candle body closure through the order block high. You guys ever heard this? This is probably brand new. No one ever talks about this. Someone tell me where the order block is in this piece of price action. If this is the fair value gap, where's the order block? Do you guys see this order block, this last up close candle? A candle body closure through the order block is going to be your swing invalidation. Write that down because this is what's going to be the bread and butter for our trades using the market maker model. Some people say it's a candle body closure through the fair value gap, but we will also consider the swing structure associated with the order block. Does anyone have a question about that? Okay, so if there's no order block, then what's it going to be? Then what does ICT define it as? If there's no order block beside it, which there usually is, but if there isn't, then it's the top candle, right? And if you don't want to put on that much risk, it can be the fair value gap itself. The reason why I like to use the order block swing structure is because this is the line of last defense essentially in bearish price action. As you can see, right? Look at how this candle prints. Do you know you're invalidated as this candle prints or when it closes? Look what happens. It comes down and then it sweeps back up, right? Here on the candle body closure is your invalidation of this fair value gap because a candle body has closed above the order block high. The reason why I teach you that is because how many points does that save you in the long term? If you use ICT's method, you might have to suffer another 15 points of drawdown. So using my method that I teach you right here, this right here is what you can write down your notes. This will save you 15 points of drawdown because once it closes through the order block high, the swing structure has failed and this high is going to get ran through. And if you don't believe me, just backtest. So now I've just found you a way to save about 15 points usually, or more, on your fair value gaps. It's a really, really cool thing. What's up? Would you get stopped out if it wicks here and came back down? So say for example, your stop loss, if your stop loss on this short, right, is a closure below this wick, and the candle does this, and it comes like this, and it comes down on a wick and then back up, would you stop yourself out or would you hold your play? This is kind of the thesis about using manual stop losses. You'll often find that and my older students will know that I do this. But when I live trade, you guys see me use manual stop losses. Right? I mean, like I manually close my position. Have you guys seen me do that live trading? AJ Gomez, you guys have seen that, right? And the reason why I do that, Joe, is because I'm taking advantage of complex swing structure. So other people will put their stop losses here blindly, right? I won't. And I'm going to teach you guys not to. Because the way I teach you, we're going to utilize these lessons. We're going to utilize complex swing structure and invalidation of swing structure. And as long as you know the rules, right, a candle body closure through a candle wick, you can save yourself a lot of money. So how many times have you ever stopped out, Joe, and then the play's gone to your TP? And how many times do you notice that it stops you out with a wick and then the body actually comes back into the range? In fact, the majority of times when you're right and get stopped out, it's because you knew the draw and liquidity, but you didn't understand invalidation of your swing structure. That's it. So people will get scared by wicks. And the reason why I spend so long on this concept right now in this lesson is because it can look scary. The body can look scary at times, right? This can look scary now, but we won't know what it actually is doing until the body closes. So for example, do you see this massive wick right here? Do you guys see this wick right here? At some point in time, guys, this was a full up close candle that looked bullish as hell. This is a candle that looked like this at one point in time. Do you guys see that? Knowing opening high, low, close of a candle. This looked like this. It was a massive up close green candle. Do you guys think that scared people out of their short positions? Yes or no? If they were short the market based on some idea. Hell yeah! Because this invalidation happened within the candle body closure time, meaning you didn't wait for the candle body to close. Instead, you simply invalidated your thesis before it closed, and it turned out to be a liquidity sweep. The best example of this, guys, is looking at your higher time frames. What do we see here on the daily chart? What is this called? These sets of wicks. Rejection block, bang on. Whoever said that, bang on. Rejection blocks are the exact thesis I'm telling you about inducing people out of their positions. Because if this was the 1 minute chart, right? You're like, oh, no big deal, I'll hold. But on the daily, there's traders who get stopped out because a candle does this. And during the day, at some point in time, this is a full down close red candle that eventually wicks up. So is this right here, right? This is a massive wick on the bottom. That's why I'm going to teach you how to properly evaluate swing structure and how to properly stop yourself out. Okay? Look at this right here. What was this on the daily? Do you see that? This was at one point in time a down close candle, and what did it end up closing as, guys? Is this a down or up close candle? Up close. But at one point in time, PMA, was this a down close or up close candle when it came into this level? And on a lower time frame, this looks like a complete and only down close candle. But you must wait for a body to close through a wick. Once a body closes through a wick, that is when you get a break of structure. That is when you get a swing point invalidation. So question, what do you think happened above these highs during the day? What do you think people thought above this swing high right here, maybe? Bullish, because yeah, at one point in time, this looked like this, right? So recognizing that, you're now going to see what was this actually in hindsight, guys? Everyone say it? Liquidity sweep. Do you see what I'm trying to get at here? We are only invalidated when swing structure is invalidated with a body through a wick. Last example, fair value gap in here, right? Say you entered on this down close candle. What do you think happened below this low to a lot of traders? Yeah. Was swing structure ever invalidated here on a lower time frame? Let's look at the 4 hour. Was this 4 hour low ever invalidated, guys? The 4 hour low that traded into this daily fair value gap, was it ever invalidated? Yeah, so what was there, when I say invalidated, I mean, was there ever a break of structure to the downside here? No, and look at the hourly. This is what we would have traded, the hourly. Look at what this is on the hourly. This is just pure inducement of this 4 hour level. Do you see that? We're coming up, and we're putting a massive down close candle and immediate rebalancing. So on the hourly, this is a break of structure right here, right? But that's why I tell you, and that's why I teach you time frame continuity, right? If you're coming into a daily fair value gap, are you looking for shorts? A daily buy side and balance outside inefficiency. Are you looking for shorts within a daily bullish FVG, guys? Yes or no? No, of course not. Like, you'd be absolutely high to want to do that. So then I'm trying to convince you that on a higher time frame, the reason why that's an hourly break of structure is within here is to do what? What's the word? What is the market doing in here by breaking structure to the downside in the hourly? One word. Starts with I. Inducement. And that's why I teach you guys about stop hunts. What is this really? That the model I teach you. What would we call this? Starts with a P. A purge, right? This is our hourly purge. This is our break of structure at the daily PD array. Right? Now we're tying it into market maker models. Someone tell me, once we get this hourly structure, where the low risk entry is. So this is our market structure from the hourly. Right? Then it's kind of chopping all day, but we have this breaker block in here. You can take longs there. Do you notice how, again, the bodies are closing above this point? Right? This all in here is just inducement. Look at the bodies. There's no break of structure ever to the downside. All we're doing is we're pushing price down to get weak longs out of their positions below these lows, and below these lows maybe, and then below this low, right? And then eventually below this low. But as you can see, the entire market maker buy model we form all the way back up, you can see it, all the way back up to here. Every time we sweep liquidity, right? Where's a good example? Right here. Oh, we don't actually take that low. Let me get an example for you guys. Right here, for example. Do the bodies close back into the range below this low? Yes, right? Do you guys see that? The bodies close back into the range here, below this low. The bodies close back into the range here, below this low. This is during London session. We push up higher. Once we break structure to the downside, the exact same thing is seen on top. These are just liquidity sweeps. And that's why understanding swing structure is so important, because this here on a lower time frame, guys, looks like bullish price action. But we don't know until the candle closes if a swing has been invalidated. So then let's write that out. A swing is only invalidated or validated, so meaning there's going to be either a break of structure or a market structure shift once a candle body closes. You have to wait on all time frames. No matter what you're looking at, the time frame you're looking at, you have to wait for the body. So if it's the hourly candle needs to close. If it's the daily candle needs to close. As you can see, every time we get a liquidity sweep, we won't know until the candle closes. That's why swing structure is so important, because it's validating our trade ideas and it's invalidating them as well. Okay, so that's kind of how we look at break structure of swing structure and what swing structure is. Let's do an exercise. Is there any questions about that, first of all? Comment? No, go for it. What's the comment? What's the comment? Mm-hmm. Yes. Yeah. Yeah, so I'll show you guys an example of what I mean by that. Good observation. You guys see my screen, right? So last week I took a decidedly polarizing play, meaning a lot of people thought that this was a wrong play. And here I like to record these types of things, because I like reflecting back on this and showing you what I mean. So here was the trade I took. I wanted us to come back into this PD array right here and then move higher. Okay, that was my thesis. As you can see, price came in to my PD array right here and tagged me in. Where is it? Right here, okay? I got tagged in right here in my PD array. You guys can see it on the right-hand chart. Do you see this? That's where I got tagged in. Then look what happened by the end. Do you see how all of these wicks closed far below on a lower time frame outside of my PD array? That was the order block. Do you guys see this order block right here? But what's the invalidation of an order block? What did I just tell you? Remember, where is a fair value gap invalidated? You guys should have this in your note if you've been taking notes this lecture. Where's the invalidation? A closure below the low of the order block, right, PMA? Do we ever get that? Body close. Because what is swing structure validated by? Body or wick. Yeah, and I genuinely think that many people thought this was a crazy play. But even if I lost, what did I tell you? Remember I was on live and I was telling you what even if I lose, why am I still happy taking this trade? I'm following my rules, right? What are my rules? What did I just tell you is my rule? A candle body closure. Yeah. So did my rule ever get violated here? No, right? What are all these wicks? It starts with an I. Inducement. Inducement. Someone who doesn't understand how swing structure is validated and invalidated is going to see this lower time frame here as a break of structure. Do you see that right here? This 1 minute quote unquote break of structure? Everyone can see that, right? Right here. How many times have you guys been burned trying to short a fair value gap that comes back into here then after this break of structure? A lot of times, right? Now you can see why this wasn't a short setup, but rather inducement to go long. Because the invalidation is going to be an invalidation of the swing structure, because structure is king. Structure means everything. And this structure was never invalidated. It was just liquidity sweeps. And as you can see, right, I said, looks good to me. I always wait for candle body closures for invalidation. We never got that. And then, 10 minutes later, price hit all my targets. I don't know if I posted that. Yeah, there you go. Right, 10 minutes later, look what happened. Price comes all the way back up and hits our target. But what I'm telling you is the time frame you're basing your analysis on is the time frame you're going to use this swing structure lesson. So after I'm done tonight, go back, take notes on everything I'm saying here, and then backtest. Backtest exactly this failure condition, right? A closure below this order block low, and see it in price in your charts, and you'll convince yourself. I don't have to convince myself more. I already am convinced, right? Because that's how I trade. I've learned it like that. Okay. So let's keep going in this lesson. Any questions about that, guys? It all makes sense. It all seems pretty clear. Am I going too fast, or is this a good pace? Okay. And it all makes sense so far? Is there any areas that have been unclear so far? I want to make sure that what I'm saying is sticking. Good. All right. So the concepts we covered this far, I'm just going to summarize at the halfway point of this lecture is, what is a swing high low? Right? Now we should be able to answer that. Right? It's a 3-bar pattern where a swing high is only qualified by an adjacent swing low and vice versa. So we've gone through that, and we'll look at some examples right now quickly. And I'm going to quickly do this, and then we'll go on to the next summary point. Let's trace the candles here. I'm going to go through this and pick out my swing highs, and you're going to tell me if you agree with them, and swing lows. This is let's go to the beginning of the day. Where do we open up? Right here in New York. Okay. Tell me where you disagree or if something doesn't make sense to you. This is a swing high. This is my swing low. This is my swing high, right? This is my swing low. Let's zoom in more. Can anyone tell me why this is my swing high and not this? Why is this my swing high and not this? Look, if I took great question. Actually, AJ, can you answer? Because we had this conversation last week. Why is this the swing high and not this? This up close candle right here. Why is this my swing high and not this high right here? Yeah, it's continuous price action. Gomez, do you see how all of these are up close candles? Where is the swing high of all of these up close candles? It's up here, right? Because what did I say is structure? Wicks are structure and bodies are break of structure. So even though this comes back down, this is all up close delivery. Is there a down close candle in between any of these? So this is the highest up close candle in this swing structure. Make sense? Interesting, right? Because a lot of times you would say, oh, well, this is a break of structure above this high, right? And often, this candle might do this, and it might actually close above this high. But if it doesn't close above this high, which I care about, you might have gotten deuced. Journal this, guys. Journal this specific piece of price action here. Take a screenshot if you want it. This is the swing high, not this. And when you ask yourself why, look, all continuous up close candles. Then we put in our down close candle right here, right? Everyone understand that as a swing high? Make sense? Say no if it doesn't make sense. Say no, please, because this doesn't make sense to everyone at first. Everyone good with that? Yes, yes. I want to hear voices saying yes, or else I'll spend more time on it. Because this is one of the most understood. This is one of the most misunderstood concepts. Yeah. I'm just gonna plug in my computer. Okay. Yes. Well, yes, because right, and the way you can think about this more simply is you can just get a paintbrush, right, a tool, and just draw all the candles as up close candles, right? Because the wicks are structure, right? So this wick is contained within this up close price run, right? But right, the invalidation of this wick in terms of structure will have to be a close above it with a body, not a wick. So as you can see, this is our swing high. Moving forward, let's see what our swing low is going to be now. Here, right? It's actually going to be, what's our swing low? This black candle or this up close candle? Which one? Which candle? And here's our swing low, guys. Yeah, absolutely. Absolutely. Because again, let's grab a paintbrush, right? We're coming in from this high, and we're coming down and putting in our pivot. And this swing low is now qualified by this swing high. Make sense? Because look, we have a swing high. So now, if we have a swing high, we have a swing low being formed, and a new pivot makes this a swing low. And then this is going to be what? If that's a swing low, what's this pivot has to be then? Which candle is the swing high? Is it the up close candle or is it the down close candle? Which one? Yes. And I don't know why people are taught that it has to be an up close candle to be a swing high. It doesn't, right? Clearly you can see. I don't know why it keeps going this. Clearly you can see this is the swing high, correct? Yeah. And then we keep moving down. And then what's the swing low in here, guys? This candle or this candle? Yes, right? Coming down. The low of this swing. I don't give a fuck about, sorry, I don't give a shit about the color of the candle. The low of this swing, right, is here. Then we come back up and put in a swing high, right? So look. Swing high all the way down. Here, I'm just going to keep this one right here. Come all the way down, putting the swing low, putting the swing high up here. Oh, actually, no, there's not a swing high because it's all continuous up close candles. What's the swing high in this area? Someone tell me. Which candle? This one, or this one? Which one do you think? 1, 2, or 3? AJ, which one? 1, 2, or 3? Which one's the swing high? Yep, out of these 3 candles. AJ says 1. Anyone say 2? Anyone say 3? Yeah, anyone say 3? So let's do 2 different colors here. Good opportunity to have a conversation. I am not going to tell you what I would say. How many votes do we have for this candle? AJ says this one. I think I heard someone else say it. Who was it? Was it Yojic? Yojic, you said, yeah, Yojic said this candle as well. So that's 2 votes for this candle. What about you, Gomez? What do you think? Okay, you agree. So we're 2 and 2. 3 to 2. 3 to 3. So I have to decide. Falcon, what are you saying? Which candle? First or third is the swing high? First candle. So now we have 4 to 3, or maybe how many people are in here? 1, 2, 3, 4, 5, 6, 7, 8. Yeah, okay. So we have 4 to 3. I have the deciding votes. What do you guys think I'm gonna say? Yes. It's not candle 2, I'll tell you that much. That's not the swing high. It's candle 3. It's candle 3. Can I show you why? If we have a paintbrush, and we're moving from this low to this high to this low, let's map with our paintbrush this set of delivery to the upside, this set of candles. We're going up, 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 down, up, 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 down. Okay, let's abstract this away from the picture. If you, oh shit, I can't because I messed up the drawing. If you look at this, right, where is the swing high? You can see it right here, right? This area right here. Right? Sorry, I wish I could take this away. I drew it wrong. You know, I'll do it again. I don't care. I want to be able to show you guys. Color of the candle. This candle here. You hit it on the head. You cannot qualify this as a swing high until what is formed? You just said it. A swing low. Where's the swing low? That's perfect, Pima. You just exactly encapsulated the lesson. What's the swing low out of these 2 candles? This candle or this candle? This candle's a swing high and a swing low. Do you guys see that? This swing high is qualified by this swing low. If this was another down close candle right here, right? This would also be a swing high, but we wouldn't have a swing low down here, right? But if this kept going up, right? So say, for example, we had another down close candle that looked just like this. That was a doji, right? Similar? So say we repeated this candle again right here. Would this be the swing high? Say I copy and pasted this candle, and I put another one just slightly above it. So it was like this, and this was a down close candle. If this is a down close candle, would this be the swing high? Yes or no? No. So this swing high is only qualified by the pivot, which is the state of delivery changing from the sell side to the buy side. Do you see that? This is a pivot right here. This is what I'm talking about. A local region of price delivery right here changes. See? Swing high. Put in here. Then we pivot and we move higher. And the highest high before we move lower is this high. Do you see that? high, then low, right here. Then where's the high? Right here, right? Then there's a low, then here's a high, then here's a low. Do you see that? How this candle on the 5 is the same high and low, the same pivot? Do you see that right here? Interesting, hey? So you can have one candle be a swing high and a swing low. When have you ever heard that before? Who's ever taught you? Have you ever thought of that even? That's okay to say no. That's real swing structure. Because I'm not teaching you some. What is it? Yeah, and this is the stuff that if you don't understand, where's the break of, guys? Where is the break of structure in here? You wouldn't know, right? You could say, is this a break of structure right here? No, because this isn't the swing high. This is the swing high. Notice, AJ, you took a play last week, right? That was very similar to this. And remember, this was your break of structure. What happened? Did the order block down here you have fail, or did it work? It failed. AJ had a play like this. Say you were playing long though, AJ, and there was an order block here. It would have failed, right? Because there's no break of structure. Notice, once you get the break of structure, look at what supports price. The order block is activated once you get the break of structure. Do you see that? This order block? That's the power, guys, of understanding swing structure. Because if you don't realize this is the high, not this, then you have no way of qualifying this as an order block, right? But this is the order block that takes price higher. And I can actually probably place a bet that if I measure the quartile of this down close candle, whoa, what did I just do? If I measure the quartile of this down close candle, this is going to be between 50 and 70%. Yeah, there you go. This is a sensitive reaction to the 70% mark of this order block only because we've broken structure right here. That's the structure break. And this is not the swing high. So many people are like, oh, this is the up close candle, right? That's not the swing high. This is the swing high. So price is rebalancing, right? This order block, which is activated after the swing high, is breached. This order block in here, or this breaker block, whatever you want to call it. This breaker block, or this set of down close candles. Understanding swing structure is now going to validate or invalidate your PD arrays as well. That's the real goal of this lesson, is to show you how everything I teach you about market maker models, PD arrays, time frame continuity, all of that only matters if you know exactly how structure is forming, because structure is what validates PD arrays. Without structure, a PD array means nothing. A fair value gap means nothing unless we have a break of structure. So this in here, right? This breaker block in here, or this fair value gap in here, the reason why it fails is why. Why does this fair value gap not support price higher? Someone tell me. I can tell you exactly why right now. I'm anticipating this fair value gap to fail. And I'm going to answer the question only using swing structure. We've taken buy side liquidity. That's the swing high. Do you guys see it? We're in a downtrend. This fair value gap has taken buy side liquidity. There's no higher objective than this swing high. Do you see how all of this is down close candles? Up until here, this is the only swing pivot, right? Do you guys see it in this day of delivery? This fair value gap, only objective counter trend of this fair value gap is to deliver this swing high. It's already been delivered. So do you think this fair value gap is going to fail or it's going to work? If the objective of the fair value gap is to sweep this high, and it already did that, do you think it's going to fail or it's going to work? And look what happens. Narrative of a PD array is defined by the swing structure. So once we've taken the buy side, this fair value gap has no purpose. What it has purpose is as an inversion. That's why it's being created as an inversion in the PD array, referring back to it. So then look, once price trades through it, we come back in, we use this as an inverse fair value gap. This is how you can anticipate inversions. I've taught this before. You can anticipate inversions by just looking at swing structure. If you've swept liquidity, right, that the fair value gap is coming off of, and there's no more liquidity targets above you, price isn't going to come all the way back up here. There's too many PD arrays on higher time frames, like this 15-minute fair value gap that it's in, right? You can see it. This, for it to go higher. So because this swing on the time frame that's the lowest time frame has already been taken, this fair value gap is going to fail. That's the power of understanding swing structure, because it validates PD arrays. So let's keep drawing our swing points. That was a good conversation. I like that. Okay, so what are we going to say to the swing high, guys? Which candle? For 1, 2, or 3? Which one? 3, nice. Swing low, swing high. Which candle? This one or this one? 1 or 2? Nice. Notice the swing low can be an up close candle, not just a down close candle. Swing high is this up close candle. Where's the swing low in this piece of price action now? 1, 2, or 3? Let me zoom in. I think it's 1, right? Do you guys see? 1 is the lowest point of the swing structure. Yo, Jake, if I draw this with like a candle, right? If I draw this with a paintbrush, we're coming down, and then we're coming up, right? Where's the swing? Where's the lowest state of delivery? It's this part. It's this part right here, right? Yep. So this is our swing low. And isn't that important to know? Because say we got a candle body that closed through here. Would this be a break of structure? If this was so actually, I'm not going to draw it with an actual candle. If we got this candle right here, would that be a break of structure? Yes or no? Say it's a down close candle. Is this a break of structure? Yes or no? No, then this, you're looking at this candle. Say it happened right here. Say the body closed right here. Would that be a break of structure? Don't look here, because you're right, AJ. Just look here. Some people would call this the swing low, right? Yeah, that's not the swing low. Even if say this is a body, right? So this is right here is a body. Is this a break of structure to you? Don't look at this candle. Ignore this. It's not. But some people would qualify this as a swing low just because it's the down close candle. That's not true. This is the swing low down here, and this has to be the break of structure. As you can see, even if we close through this candle is the break of structure. AJ, you're right. This is another. So then look. We have a swing low down here, right? Coming down. We said that's a swing low, swing high, swing low. We have another swing low formed here. We have another swing high formed here, right? We're coming up and then down. Do you guys see that? This up close candle is the swing high and low. Because we're moving up and then down, then up. Coming all the way up here. Swing high, swing low. What about in here? Which one of these candles is a swing high? Yep. Where's the swing low? Same candle, right? Coming up. Ever that makes sense to everyone? AJ, does that make sense to you? We did this last week. Yep. Swing high, swing low, right? Swing high, swing low. Keep tracing it, keep tracing it. Coming up, coming down, coming up, coming down, coming up. $12, $15. Oh, it might be, actually. I might have drawn it wrong. Let me see. This is how I do it in my head. I'm showing you guys what I do. I actually just paint out each of the candles. Up, then down, then up. Oh, you're right. You're completely right. Good catch, PMA. Right? Because this is the highest point. No, this is the highest point in delivery of these candles, right? You're completely right. So you see how easy it is to miss? You see how easy I just did it right there? I completely missed it. Because look, when you're looking at this set of up close candles, right? This is the up delivery before it comes down. Because what did I say wicks are? Wicks are structure, right? So we have to consider the wicks as a part of the structure, meaning this is a full up part of the structure. Make sense? Good catch, BMA. Then we come up, then down, then up, then down. Yep. Do you guys see what PMA is talking about? Let me get rid of the rest of these dots. How many of you guys also saw what I saw? Because it's a really easy mistake to make. I just made it. How many of you? 11:05. This slow right in here. It's this one, right? Oh, it does? Are they equal lows? Is it, or is this? Oh, on MNQ, on yeah, yeah, on MNQ. Then actually these are equal lows, you can say. So the swing low in this case is both of these lows, right? Yeah, that I want to go to PMA's catch right there because I got it wrong, and I want to see how many of you guys also got it wrong. I think we all got it wrong. I think PMA, you're the only one who saw that properly because no one said anything. Did you guys also see what I saw? And this is the swing high. You're right. You're completely right. I didn't see it. I put this one just blindly following because in my head I'm always thinking like, oh yeah, this is up and then this is down, right? But this is actually all up. Do you guys see that? Does that make sense to everyone else on the call? How this is all up delivery? Yeah, that was a really good catch by PMA. So this is the swing high, not this. This, and then this is the low, and then this is the high. These are the equal lows. This is the high. This is the low. Come all the way up. This is our high. Then we have come all the way down. This is our low. Wait. Yep, this is our low and our high. Do you guys see that? Putting a low and then a high and then a low. Do you guys see that in this candle? And again, it's not odd. Like, how many times have you thought of the same candle being the same, like being the swing point of the low and the high? Not very often, right? But this is important to notice because if you don't see this, then you're not going to validate what the break of structure is. You might think this is the break of structure, wouldn't you? Above this high. Which one? Can you give me a time? Can you give me a time? 1 p.m. Oh, is this an up close candle or a down close candle? This is a down close candle, right? It's a down close candle, so it's all one side. If it was up close, you're right. It'd be a swing high. So do you see how this is all bearish delivery? But if this was an up close candle, it'd be a swing high right there. Yeah. What's up? Mm-hmm. No, I don't like those candles. As you probably are already recognizing, those candles aren't great probability, right? 3 can, yeah, of course. Yeah, like a candle like this, right, is because this is what's called an inside bar right here, okay? Meaning this entire bar, the entire next set of swing points. Do you see how if I can draw it like a trend line actually? I'll draw it like this so you guys can see. This is complex, like candlestick patterns, but do you see how this entire range in here between these two candles is contained within these two swings, like these two wicks, until we put in this low and then this high? That means that this inside bar of 10 minutes is contained by the swing of this high and this low. Does that make sense? So this is both the high and the low because this candle is a complete inside bar. Make sense? Or not make sense? AJ, did that make sense? You make sense? Yeah, okay. But it's not the highest quality break of structure, is it? Right? Like I don't like when I have to trace a candle and it looks like this. I'm coming down and then up and then down and then up, and this is the high and the low. I don't really like that as much. Yeah, so let's get into that now. Perfect. So now everyone is good with swing structure. What the drawing out these little dots looks like. Everyone's good with that. Cool. If we're good with that, now we can start qualifying different types of structure. Cool. So that's the last part of this lesson. So the lesson that we've done so far is what is a swing high, what is a swing low? Everyone can answer that question. What is a break structure? A candle body closure. Let's keep doing summary. So this is summary. The questions you want to be able to answer when you study this, review this lecture is what is a swing high, low, in terms of a candle pattern? What qualifies a break of structure / MSS versus a liquidity purge in relation to swing structure, obviously. Swing invalidation and swing validation. Okay, the next question is how can you draw dots on swing highs and lows? Essentially, that's it. The fourth thing we're going to cover, and the last thing I want to do in this lesson is what are the different types of swings. And there's long-term, intermediate term, and short term. So let's talk about that. Everyone cool with the first three? Everything thumbs up. Let me just everyone is good with the first three concepts. No questions about those three, right? Sounds good? Yeah, of course. Yeah, absolutely, bro. The most important part of this lesson is being able to mark out the dots, believe it or not. The other stuff is very good to know, but the most tactile part of this lesson is the dots. So let's do it. Let's start right here at New York Open. So swing high, swing low, swing high, come down, form a swing low and a swing high, and then a swing low and a swing high, a swing low, a swing high, a swing low, a swing high. Ugh, this is disgusting. Okay, is this an up close candle? No, it's not. Down close, up close, swing low, swing high, swing low, swing high, swing low. Okay, in here it's just disgusting. I don't need to mark that out, do I? Does this make sense based on here? Any one of these that you don't agree with from here on the 15? Yeah. No, it's not. It's not. Yeah, what's up? Okay, wait. Let's see. Which one? Between 12 and 130. So this is a swing low, and so we come up, and then we come down. So this is a swing low right here, right? Oh, did I? Oh, sorry. Did I mark out this one? Oh, my apologies, guys. I did it too quickly. Okay, that's wrong. It's this one. Sorry. Yeah, yeah. No, you're complete. Please call me out on this. It's this down close candle, 100%. This is a swing low, and then this down close candle is a swing high. So not the up close, and that's what's perverse is that people teach this just saying look at the color of the candle. It's just that's such bullshit. It's not that's not swing structure. It's nothing to do with the color of the candles. This down close candle is a swing low, and this down close candle is also the swing high, right? And then this down close candle is the swing low here. And then this up close candle is a swing high. Because this candle is coming up, then down, then up, right? The best way I can teach you is just paint it. Up, then down, then up, then down, then up, then down, right? If you do that, does the painting of it with the paintbrush make it easier to visualize, guys? Because for me, it makes it 100 times easier to visualize. Using this little paintbrush and actually painting in the wicks, because the wicks are structure. So that's yeah, okay. So that's the first three. You guys know what a swing low is and a swing high. You know what qualifies a break structure versus a liquidity sweep. And the most important thing to remember for point 2 is we wait for the candle to close on the time frame of the chart. On a 1-minute chart, this looks like 500 breaks of structure to the upside. Right? Again, same example, just to reinforce it 100 times. On the 1-minute chart, How many breaks of structure to the downside do we get in here, guys? You can count them, right? 1, 2, 3, 4, right? How many breaks of structure to the downside do we get in the 15-minute chart? Zero. There's no swing low broken, right? This is why when price does this 10 minutes later, there's idiots who are like, the market's broken. The market is not broken. This is complete logic, right? This is complete validation of this swing low. This swing low has never been violated. And we're putting in more swing lows that are not being violated. Yeah, so when you get stopped out of your shorts and you're like, the market's broken, it's because you don't know swing structure. And now you guys are never going to make that mistake again, ever. Because the time frame you're looking at is going to be what you consider. Not this chart. I don't give a fuck about this chart. You're looking at the time frame that you're looking at the swing structure on. I heard PMA say, God damn it. Yeah, the candle body must close below the wick. As you see right here, just a liquidity sweep. And then we put in a lower low, and then another liquidity sweep. See, this is a swing low. Low, then a high, and then you see how this down close candle puts in a short-term low on a lower time frame, like a 5-minute chart or something. Then we come down, and then this becomes the low. Right? You're painting this. Yep. So that's point 2. What qualifies a break of structure versus liquidity purge? Now you can answer that just in relation to swing structure, nothing else. Swing structure invalidation is a liquidity. Swing structure invalidation is a market structure shift or a liquidity purge, PMA. If you get invalidation, I mean you close above or below it. Which one is it? Market structure shift, right? And swing swing validation, meaning a swing remains a valid swing low if it doesn't close. Then we call that a liquidity purge. So all I'm doing is I'm redefining these ICT terms in terms of what they mean for swing highs and lows. Does that make sense? So an invalidated low, right? I mean, a low that didn't hold means a body closes through it, and that's what ICT calls a market structure shift. And then a valid swing low, meaning a low that doesn't have a body close through it, is what ICT calls a liquidity purge. I'm just trying to make sense of these words in relation to just swing structure and nothing else. Okay, so the last thing we're going to talk about is different types of swings. So as you can see, there is 2 different swings immediately obvious on this chart right here on the 50-minute, right? There's this high, and there's this high. Someone tell me the difference between the 2 highs. And just using time frame, which high has a higher time frame associated with it? This one or this one? So this line here, which I'm going to mark as the red line, or this line here, I'm going to mark as the blue line. Which one has a higher time frame high put in? Just from the 50-minute chart, you can tell. Maybe I can go to the hourly and you'll see. Red one, right? The red one is a higher time frame high. The highest time frame high on a chart is what we're now going to define as our, so the highest time frame high in a dealing range, I'll make it better, is what we will define as a long-term high, LTH. So what's a deal? Everyone knows what a dealing range is, right? I'll define it again, just to make sure. A dealing range is a section of price action that contains a low and a high. A dealing range is qualified by a liquidity sweep to the upside and downside. That's the simplest way to think of a dealing range. That's not the way it's taught, that's the way I understand it, and that's what I'm going to teach you guys. So, in this area here, right? Or actually, instead of saying a liquidity sweep, why don't we just say this? Qualified by a swing low to the upside and downside. How about that? So in here, what's our dealing range, guys, from this piece of price action to here? Right, in here. So this is our dealing range. Okay. In a dealing range, right, there will be a long-term high, and necessarily there will be a series of shorter-term highs. So the dealing range is, so if we look at a market structure like this, point A to point B. So if we call this point B, and we call this here point A. In between point A and B, actually I'll just define it like this instead of doing the dealing range thing. In a point from A to B, we are going to define this is a dealing range if A forms a swing low like this, and B forms a swing high like this. So essentially what we're looking for is a dealing range consists of a 3-bar pattern on the low that looks something like this. This is what we're going to call A. And point B is going to look something like this. As you notice, my original definition, right? A dealing range has a liquidity sweep on either side. Do you guys see how, in this case, you can see the new dealing range is put in because this low has been taken and we have a new swing low, a new 3-bar pattern here. So if this was once our dealing range from, let's say, A to B, right? We're going to have a new dealing range from A to B. Make sense? We're putting in a swing high and a swing low. Does that make sense to you guys when I say a dealing range like that and define it in terms of a swing structure like that? Okay, so the long, yeah, exactly. It's exactly there. You go. A price leg. That's the perfect definition. I just want to give a more like robust definition for what a leg means. A leg just means a long-term low. So we are going to define in a dealing range, right? We can write this down. In a dealing range, we're going to define the long-term low as the lowest swing low and the highest swing high. That's an easy way to do it because time and price are going to be reflected, right, by the highest and the lowest. So I don't have to go up a time frame to know that this high is a higher time frame high and a higher high than this high because I can see it in the dealing range. The highest high in a dealing range and the lowest low in a dealing range are called our long-term highs and lows. Everyone make sense with that? So now we're conflating time and price, right? We're using, right, the idea of the lowest swing point being the highest time frame swing point, and the highest swing point being the highest time frame swing point high. That's how we can combine time and price just looking at a dealing range. Okay, so in between A to B, we're also going to have a whole bunch of intermediate swings. So these intermediate swings are going to be contained within the A to B leg. As you guys can see, if we use our A and B as, let's annotate this piece of price action on the 15. If we use A to be this low, and we use B to be, this high, do you guys see all of the swings contained within here? Until we break structure. So, do you guys see all of these swings contained within A to B? These are going to now be classified as either intermediate term highs or short-term highs. So let's do that right now. An intermediate term high looks something like this. If we have a swing low and we put in another swing high, right, within the dealing, so let's look at the dealing range, A to B. So A to B is right here. If we have our swing high and we put in another swing low, if that swing low is higher than point A, right, it immediately becomes an intermediate swing. So let's write that out. If we have a defined dealing range, A to B, and we put in a swing low that is higher than A, that swing low immediately becomes an intermediate term low. That makes sense to everyone? If it doesn't, ask questions. Let's call that an intermediate term low C. That makes sense? Everyone's okay with that? Okay, so point C, I'm going to annotate just live here. Point C looks something like this. Okay. If we put in, so now let's go one step further. If we have a dealing range of point A to B, and we put in a swing high that is lower than B, that high immediately becomes an intermediate term high. We're going to call that point D. See? And then, so what does this high become, guys? If I'm lettering this high right here, what are we going to call it? So we're going to call it D, right? Perfect. Okay. D high. Actually, I'm going to use just this C and D. Is it okay if I switch it from this C and D right here? So I can paint you another picture? So I can do one more example of what a short-term high is. Are you okay with that if I change it from this low and this side to this low and this side? These are both valid C and Ds, right? Do you agree? This is a C and this is a D based on our definition. Guys, write these definitions down. This is a valid C definition and this is a valid D definition. Likewise, this is a valid D definition and this is a valid C definition because this low is higher than A and this high is lower than B. One more definition for you guys, or two more sets, I guess. If we have a defined intermediate term dealing range from, you guys are going to guess where this is going, C to D, and we put in a swing high that is lower than D, that swing high immediately becomes, what are we going to call it, guys? Short-term high, E. Does that make sense? I hope you guys are seeing this all, this internal consistency of these things. That makes sense, that statement. Yes, no? Confusing, yes, no? Okay, so I'm gonna show you what that looks like right here. Our defined intermediate term dealing range is C to D. Do you guys agree that C and D is a complete dealing range, this in here? Yes, right? Because it has a swing low and a swing high, correct? And this is a valid C because C is higher than A and D is lower than B. So now we have a dealing range within a dealing range. Ah, cool. Inside the swing leg C to D, which is contained within A to B. Sorry, it sounds like math, doesn't it? Holy shit, this brings you back to university math. Talking about like Venn diagrams of containment, sorry. So inside the swing leg C to D, which is in A to B, if we have a swing low that is put in, or a swing high that is put in, that is lower than D, that is going to be our short-term high. And if we have a swing low that is higher rather than C, that swing low immediately becomes F. So this sounds like a lot of fucking English. Can someone tell me? Oh yeah, that's what I mean. It'll always have to be to the right, right? It's after. So we always want to be looking in the future, I guess is what you're saying, right? There was an F. There was an F, not E, right? That's what I was gonna ask. In C to D, can you guys find the F? Where tell me where F is. I'm gonna stop on the candle, you're gonna say when. So is it the C candle? Is it this candle? Is it this candle? Actually, there is. There's E and F. There's both. Yeah. So what you can say here is that this high in here is what? This is E, and then by definition, if there's E, there has to be F, right? Because they swing high in this candle right here, right? But no, right? F has to be what does it? What does it say? F has to be higher than C, and E has to be lower than D, right? So I'm sorry, this is a confusing concept. There is no easy way to teach this. The way I'm teaching it to you is the easiest way that I was taught by watching a Coursera course on market structure. This guy literally used the same A, B, C, D, E, F. What you're trying to show here is that A and B, right? Let's use different colors. Let me try and make this clear because who's a little bit confused? It's okay to say you're confused. Anyone confused? It's okay to say you're confused, guys. Like this is not an easy topic. So A to B, I'm going to mark out with this dealing range right here. And that's black A and black B, right? This is the highest time frame dealing range. So let's make this the biggest on the chart. Okay. Within this price leg of A to B, we are going to find lower time frame swing structure. We are going to call any lower high point. What point are we going to call that? Any lower high than B. What are we going to call that? Yeah, an intermediate term high, right? So for example, in this case here, we have D, right, as going to be our lower time frame high. And then within D and C, which is our lower time frame low and high, we're going to zoom in even more. So now we have this, right? We have C and D, and these are going to be blue, and we're going to make them a little bit bigger. Now we have a new dealing range. Within C and D, there's also going to be the shortest term highs and lows. This is the lowest time frame highs and lows. This is going to be within this leg here, E and F. Does that make sense? Okay. So when we're looking at swing structure, right, we want to be looking at the time frame continuity of these swings in terms of what's the highest quality break of structure. So yes, if we're in this dealing range C to D, right, between B and A, and we break through F, is F going to be a higher or lower quality break of structure than C? Which one? Higher or lower quality break of structure? Why? Because it's a lower time frame pivot. Have you ever heard the expression higher time frames hold higher powers? This in here can be considered a range. We are in a range, right? Once we leave this range, right, you can notice there is internal breaks of structure. This is called an IBOS. Internal break of structure. Internal break of structure. What is a closure through this low down here called? a break structure, right? So say this was the lowest leg. Do you see the difference between these internal breaks and this external break, essentially? That's the difference between short-term swing structure and long-term swing structure. And the only purpose of this entire conversation is to now direct your eye to the chart where you can see where the highest and lowest quality breaks of structure come in. Okay? That makes sense? So the reason why we have these different time frame swing points and the reason why it's important to kind of mark them out is because if you go to maybe, so everyone have this down, these things, if they want, I can just take a picture of this. I can put it back up later. Okay. Let's go to like a daily chart. There's a reason why this stuff's important. What would you guys classify this as? Yeah, a range. What's another word for a range? Starts with a C. Yeah, perfect. That's a consolidation, right? Based on the conversation we just had, how do you think I'm going to use the topic of swing structure to explain high probability and low probability conditions? Someone take a stab at it. What about this? This is the answer to the question, right? How do we trade, or how do we know what trading days are going to be high probability and low probability, right? So let's mark that as our consolidation. If this is our consolidation range in here, where's the high and low? Where's the high and low of the dealing range? Let's mark out our A and B. These dots. The high of this consolidation is right here, correct? Do you guys see that on the chart? And the low is going to be this low here, okay? So these yellow dots are going to be our A and our B. Let's go down to the hourly now. And let's expand this upwards. Okay. So you could say we're consolidating here. If you wanted to really, trade the highest probability expansion, do you notice how this was the week where a lot of people lost money? P-Man, do you remember this week how we kept range bounding all week essentially? We never expanded really higher or lower. Me and you are having this conversation. Based on this lesson alone, right? How are you going to use what I just taught you in terms of qualifying low and high probability conditions? What are you going to wait for? Yeah, but remember, here's our consolidation high and low. So let's call this A and B. Let's mark out the rest. Someone give me my C and Ds for this. Here's a C, right? Here's a lower, let's make this a different color. I'll make this red. Here's a higher low, and here is a higher, actually, let's mark out this high here as the original high. Okay, so this is a higher low, and this is a lower high. When we break past this high right here, PMA, do we have better or worse confirmation of higher prices than if we break past this high? This is our internal break of structure. This is our break of structure. So when you're trading, right, and you notice you're in a range, you're between a high and a low, and we start to put in, right, lower highs and higher lows. Like, so let's do the same example in this range here. Here's the high, right, and here's the eventual low. This high here is lower than this high, and this high here, or this low here, is higher than this low. Inside here, you'll notice we have what is this? Is this low higher or lower than this high? Or is this high higher or lower than this high, PMA? Right here. Okay, let's give it a different color. What color do you want to give this? Blue? Green. Okay, now if there's a swing high that's lower, there must be a swing low, and it's going to be, yeah, but like right now we wouldn't know that this is the swing low. We wouldn't know that this is going to be the swing low until it's formed, right? Like you said, you have to look right, correct? So all of this happens after. All we know, looking at this chart right now, say if we were right here, is that this is a lower high, correct? And that this is the lower low so far, right? Because we put it in earlier. So we put this lower low in. Now we put in a lower high, and now we're waiting for a lower low to put in, a lower low than this one we put in. Once we break above this high, right, we can anticipate that price action is going to be less, like it's less high probability than if we break above this high. Because if we break above this high, the only major resistance left now in terms of the swing high is going to be the next higher high we put in within the dealing range. That's why we have to be considering these internal breaks versus the entire range break, which eventually happens here. The entire range break happens here, and then look what price does. It goes on a one-directional run. Now, this is confusing. Yeah, totally. So I've never liked like higher highs, lower highs, the concept of it. I also don't think I'm good at teaching it. Let's be real. I don't like these concepts because for me, I try and trade every day. But it is very valuable, right, to understand it at least. And it's not a particular strong suit, I think, of mine, but understanding that we have a long-term high, right, and a long-term low, and then just essentially saying, whatever one of these breaks first is going to lead to the expansion is a good thing to consider. Okay, is that a better way of me to teach? Better way for me to teach it? While we're ranging in between this dealing range, right? We have to remember that these are all lower highs and higher lows. This is still contained within the dealing range. So we expect consolidation until we break this high, or we expect expansion. Which one? Consolidation, right? Okay, so there we go. I tried teaching this. I just realized halfway through teaching this I'm not teaching it well. Sorry, not a strong suit of mine. Wait until this high breaks, and then you'll get one directional movements. Maybe that's the best way to say it. Okay, let's just backtest that so you can understand that concept. That's what I'm trying to make sense of. Again, someone on this daily. Let's go to another level of consolidation. Do you guys see this in here? Whoops. Do you guys see this piece of price action in here? Would you call this consolidation or expansion? Okay, so mark out the high of the consolidation and the low. Let's go down to a 4-hour. Until we break the consolidation high or low, are you expecting, right, expansion or consolidation? So when you have a price run that is defined within a dealing range, right, like this, and then you see that we're putting in higher or lower highs, like here, and then we're putting in higher lows, like here, you have to be adjusting your kind of TPs or your essentially your bias such that a run from here will probably, right, fail to go significantly higher or lower unless this high is broken, not this high. Not this high even. Do you see how we keep creating these intermediate ranges? Really, we're going to keep ranging until the consolidation high and low is broken. Notice, compare this price action, right, in here, which is still tradable. Do you guys see the market maker models in here, by the way? Let's go to the 1 hour. Do you guys see the very clear market maker model in here on both sides? Like this buy model and then this sell model? Compare this price action here to when we break this low, which is a what type of low, PMA, is this? This is a long-term low of this dealing range in here, right? Of this consolidation on the daily, right? On the daily, we marked out the consolidation, right? So even we can stay on the daily because that's our highest time frame, right? Once we break this low, look at how one directional price is in comparison. Do you see that? Now this is fractal. So what I'm trying to say, and what I'm trying to teach, and I hope I'm doing a better job teaching it now, is that when you look at the hourly, right? Look, this is our intermediate time frame that we trade, and you see this like we did the past couple days. What can you expect in between this high and this low? What do you think is going to happen? Consolidation or expansion? And look what happens on our trading time frame. This is not like expansion. This is hard to trade, right? Consolidating, massive move down, massive move up. Like this is hard to trade, right? And then look at this. Is this hard to trade in here? Yeah, honestly, this is hard to trade, right? Look at this price action. You're just kind of chopping down all day with these massive retracements up, right? Like you don't want to be on the other side of one of these massive retracements up, do you? Would you call this clean expansion to the sell side, guys? How many people lost money last week? Be honest, trading this. Don't lie to me. No one lost money trading this last week? Wow, you guys are fucking pros. No one lost money here trading this last week's price action. Okay, okay. I like that. You tried to leave it alone. Okay, whoever was here last week. What did I do last week? Did I trade any of my PAs? What did I tell you the week was going to be? Probably like at least this day was going to be Wednesday. Choppy, right? And the reason I said it is because I'm using this concept here, which this is what I'm trying to teach you. If you get nothing more than this kind of intermediate, long term, what the fuck's if he's talking about? It's when we're in a consolidation range, right? On the hourly, for example, you see it, this consolidation range, and we're not displacing through the high or the low, expect some really shitty price action, or not shitty, just expect consolidation until, look what happens when the low actually breaks. The low breaks, we come back into what? Order block? Look at how one-sided this delivery is. Do you see that? Compare this with this, right? What would you rather trade, guys? This or this? This or this? Which one? One or two? One or two? Obviously. So how do we identify? Someone who asked me the question, Smokey, was it you who asked me the question, when do you know when price is going to be like choppy? Was that you who asked me that? I don't remember. Okay, I remember someone asking me earlier. It might have been Niku. It might have been Niku, who's one of our new students. How do I know when price is going to behave like this? It's using this exact concept of short and long-term highs. Let's find one more example on the hourly, and then we'll wrap up the lesson. So, do you guys see this consolidation in here? Okay, so all we have to know that we're going to get some choppy price action is, again, mark out our long-term high and low. In this 1 hour, you can see we're defined essentially by this high. It's a gap, but it's this high and this low. Whoops. Until one of these gives, right, we're going to be in a consolidation. As you can see, putting in low intermediate structure, then we're putting in short-term structure, and then eventually when this high breaks, look at the delivery. Boom, boom. Again, let's do consolidation and delivery again. You guys see this consolidation right here? Clear as day, right? Where's the high and low? Here's the high. Where's the low? Here. Let's go down time frame. Do you guys think this is very tradable in here? Be honest. Is this tradable? This sucks. This sucks, right, guys? You can say it. This is trash, right? Do you think you're going to make money here? Be honest. No. PMA's like, yeah, well, me, I'll make money. You guys, I don't know about you guys, but me. Yeah, but look what happens when we break this high, which is a consolidation high. The hourly. Clean, one-sided expansion. There's nothing that you have to guess here. There's no drawdown. There's no like ew, what is it? It's just boom, boom. Look at the 5-minute delivery. It's just all up close candles all the way to terminus. Then look at this. Last example. This is the best way to teach this. Okay, from now on, I'm teaching this concept just like this. Let's look at the 5-minute for another example. Where was that delivery we just marked out? I lost it. Oh, right here. Do you guys see this in here? New York AM session. Is this at all tradable? This is the literal death of accounts in here, right? Same with this. This is how accounts get absolutely torched, right? Same with this even. Okay, so let's look at this piece of price action. If you tried to trade New York Open here, you're getting jawboned around for the first 30 minutes. Instead, mark out your long-term high and your long-term low. When one of them breaks in the direction of your bias, look at this. Just wait. This is the long-term high. Even this right here is a long-term high, this consolidation. Once it breaks, look at this. Clean, clean, clean. Then look, once this high breaks, return back to a breaker. Clean, 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 clean. All the way up. In here, this is where you can chop yourself up. Are you going to trade lunch session anyways? No. But do you think accounts are made or blown in this price action? What do you think? Blown. This is hard to trade, and it's okay to say it. Someone tell me where the low of this consolidation is, of the dealing range. Here, right? Where's the high? Do you see all the intermediate structure we're putting in? This low, then we're putting in this high, this low, this high, this low, this. You see all this intermediate structure in here? Is a break of any of this structure going to be high confluence? As high confluence? Yes or no? It's going to be lower confluence, right? Yeah, the lowest low, right? So all of this intermediate structure in here is essentially hard to trade. Like, look, say we break above, below, we break above this high. I mean, we don't, but say we did. You want to be hesitant until we break above this high. Have you guys ever heard of me saying I want to add to my winners? Where do you think I'm going to add to my winners? When we break below the major structure lows and highs, right? Look what happens after we break this low on a lower time frame. All one side delivery. Look, it's literally one candle delivers the entire sell side. Again, look at this PM session. Are you guys going to trade this? Are you guys going to make your account here or break your account? There's absolutely no way to trade that. And the reason you can know that, yeah. So the question you should ask me then is Gomez, how do I know it's going to be like this, right? What's the answer based on the lesson that we've had today? What's the answer? You have a long-term low. Well, no, just use the terminology of the lesson. We have a long-term low, right? And then we have a long-term high. Even here, if I say you don't see this candle, say you only see this candle, right? You have a long-term low and a long-term high. These two candles. Until, as we're putting in secondary structure, lower high, lower high, higher low, lower high, higher low, blah 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 blah. Fuck all of that. This is all so impossible to trade. When do we finally get a clean move? Let's look. Look at this. I mean, extend this consolidation. Do you see the concept here? Extend this. All of this is untradeable. Do you see it? Can you trade any of this? Do you see how it's all contained by this? I'm going to mark it out to make it picture clear. This is the high, and this is the low. Is any of this tradable, guys? Into the London session, into the Asian sessions, any of this tradable? Say it with me. Hell no. Hell no. Hell no, right? This is not tradable. But as long as you have these 2 points marked out, this point and this point, you're going to wait for your long-term dealing range high to be broken. And look what happens once it's broken. We break this high, we return back into the PD array. Let's go to an hour, see what it looks like. Break the high, come back into this set of down close candles. What is this set of down close candles, guys? What's this called? A down order block, right? Yeah. Come back. So once we break, no worries. This is also a breaker here. It's the same, equally as good. Once we break structure, we refer back to the algorithmic point, and then it's the entry model I taught you guys. Where is it? Right? In the New York AM session, what a surprise. Come back into the breaker, break structure right here on the 5-minute. Here's our low risk entry, the order block. Take an entry in the order block. This is not hindsight, guys. I just did this example live with you, right? Can't cherry pick this. Take an entry in the order block. There you go. Here's your expansion. Boom. And you get, so Gomez, how many hours did you get to not trade? How many hours do you have to watch price do absolutely nothing for? Let's take a look. For all those guys. So, you know, what's the target? The target's this high, right? And it's been that high for 2 days, correct? So the neophyte or the person who's so itching to put on a trade is gonna try doing shit for 18 hours, 24 hours, a full day. You're just fucking around. Sorry for my language. You're doing absolutely nothing but destroying your account, doing stupid fucking shit. All you have to recognize is that this is low probability based on these 2 points. I got 2 damn points on my chart, man. Sorry for my language. You got 2 points. When you see it like this, and now you've done this lesson with me, you know what to look for. You see a range. You see a range like this. You see a range like this. Wait. Just be patient. The minute we break out of the range, we come back into a high probability order block. We break structure on the 5. We refer back to the 5-minute, and you get the entire move you wanted to this high. For the past 18 hours, you get it in how many minutes, Gomez, is this candle on the 5? Tell me, how many minutes is this candle right here that I have marked out? 5 minutes. You get everything you've been waiting for 2 days in 5 minutes, and you just telling you right now, don't trade the range in here. Don't trade the consolidation. I never do. And that's why swing structure is important to recognize. So if you take away nothing else from this part of the lecture, recognize that we have long and short-term highs. And long and short-term highs promote consolidation. Don't believe me? Look at any time frame. I'm going to delete this chart. Let's go to the monthly. Okay? Long and short-term highs promote consolidation. Look at this. We have a monthly long-term high, and we have a monthly long-term low. In the monthly chart, we are consolidating. Until when? We break the long-term high, and then we get 3 months of up-close candles. Do you see that? You get expansion. It's a monthly chart, right? Monthly. Look at this. Say you're trading back in 2018, and you're getting jawboned around by the market. We have a long-term high, and we have a long-term monthly low. What are we doing in between here? Nothing. Chopping up, chopping down, chopping up, chopping down. Once we break the long-term high, look how clean price action is. You guys want me to find you an ICT model on the monthly chart? Sure. Break a structure of the long-term high. Where's the order block, guys? Someone mark it out for me. This candle, right? Come back into this order block, or you can refer to this order block, whatever you want. Right? Price trades up, breaks the structure, comes back into the order block, and then how many months in a row, guys, do we get of clean price action after this shit? Like after this, how many? So again, let's consider the time here. For 551 days, we move a total of, wait, I'm going to keep this there. For 551 days, we move a total of 2,000 points up and down, right? Is this one directional or two directional movement, Gomez? Yeah, that's not a true state. It's always two directional. This is consolidation, right? And it's 2,000 points. Now compare it to when we just break the high, the swing high, the long-term high. In 551 days, we moved 2,000 points. Let's see, where do we break it? We break it right here. In 300 days, we move 5,000 points, or 4,500. We move double the amount of points in half the time. Just using the simple idea of swing structure. Do you see that? Because we're trading the expansion. And if you guys are students of mine, you're going to know I say to you, even on a day like today, we're going to be trading this expansion up. We're not going to trade this garbage. Like, do you guys want to trade this choppiness down? Yes or no? Which one would you rather trade? This up or this choppiness down? Which one? Or this choppiness in here, or this move up? Yeah, you want to trade with low resistance liquidity runs. Every time frame chart, just using the idea I told you, and also some of the other concepts I'm going to teach you, are going to lend itself to this idea. So again, what do you see in here? A swing high and a swing low, right? Do you see how the entire, let's go down to a daily time frame. Where is that? Do you see how this is hard to trade? Is this hard to trade? Yeah, right? Like there's no, like we're going up and then down and up and then down. If you're trading a weekly, if you're swing trading, it's not easy. But look what happens when we break this high on the monthly. Then we just have a nice, clean, one-directional trending market all the way up. You see that? You see the difference between this and this? It's clear, right? And it's on all time frames. And it backtests us after. When you start to see consolidation ranges, just look for your swing highs and lows. Same thing in here on the daily, right? Swing high, put up here. Swing low, put down here. Then we have some jaw boning. We have this, we have this, we have this. Like these days are just moving kind of like that, which is fine. But in here, we're kind of moving up and down. Once we break this high, look at that. There's no more up and down. It's just nice trending all the way up, right? Because this piece of price action in here is almost unbearable to trade. Like, I don't know if you guys see this. Do you think this is easy or hard to trade? Look at the daily chart. Do you think this is easy or hard to trade? Guys, this might be the single hardest conditions to trade. Like, look at this. Like, there's no trend here, guys. We're going down, sure. But, like, every day is like a massive daily retracement almost. Every other day is a daily retracement. Then we start to trend a bit more. But really, once we break this high, it's just a clear sailing. Then it looks just like a really clean chart of just minor pullbacks. Huge expansions, minor pullback. Huge expansion, minor pullback, and then nice trending all the way up. Not whatever this thing is in here. Same thing. Last time I'll show you. Look, right? Draw your box. Swing high, swing low. Once we break the swing high, we just go on a nice low resistance run. So that's the concept. Does that make sense the way I explained it the second time? Patience pays. Looking to not trade this, right? We don't want to trade this. And if you find yourself trading this, it's okay. Just calibrate, right? Say, here's my, like, here in this dealing range, this low, this high, and this low maybe, right? Until we break above this, look what we're doing. We're just, like, literally the market is just doing this. Then look, we break the low and what happens? Someone tell me, the minute we break this low, what happens on this chart? Nice, clean delivery. So recognize that. And the way you recognize that is this lesson. It's looking at higher time frame lows and lower time frame lows and just saying, okay, where am I in relation to those higher time frame pivots? Like, where am I in relation to this pivot right here? Swing high, and then maybe, let's say this is your swing low. Right, so then again, we're coming up, then we're coming down, then we're coming up, then we're coming down, then we're not breaking below this low, we're coming back up, then we're coming back down, and we're coming back up, and then we're coming back down, and then we break the high. Let's take this chart away. This has been kind of trash to trade. This is not bad, but this is kind of trash to trade. Once we break this high right here, we get a retracement and then expansion. Look, this is literally an ICT model right here in this price action. Once we break this high right here, which is the high of the dealing range, then we get a return to this order block on the daily, right? This fair value gap on the daily. Look at the bodies. The bodies perfectly hold the PDRA. We get some consolidation again, right? Inside, this is trash. You can recognize it right away. This is not what you want to trade. You cannot trade this and say you're having a fun time. But once we hit the here's a second. What are we doing right here, guys? What model is this? Starts with an I. Have you guys watched my inducement model lecture? You notice how we're chopping above? Yeah, do you know how we're chopping above? Like, so let's say this is the fair value gap, right? Well, let's say this is the order block of interest. Do you see how we're chopping above it? We're not actually hitting it, right? Like, let's look at discount and premium. That's a good way to bring the lessons together. You see how we're just chopping above near the 50% mark? And then eventually, we come into what? What is 70.5? OTE, right? What's the PD array? The PD array is the daily order block. This is what, and look at dollar, guys. Same shit that I've been telling you. We've been chopping around this stacked PD array, right? Now we're going to run through this sell side and then push up to the buy side. Right, so let's look at the 4 hour. What does that look like? It's this sell side sweep, and maybe we're trading into this right here. But we're inducing above. Like, look at this. Same exact shit. We're putting in a massive quote-unquote flag, a bull flag, and then a bull flag is going to break to the downside first, like it always does, and then it's eventually going to push up. So here, bull flag, break to the downside, finally hit the level you want, and then it's just days and days and days of clean price action. We trade this. We don't trade this. We don't trade this, and we don't trade this. And if you know me and you work with me for long enough, you'll see I'm not just bullshitting. I actually don't trade these conditions. So this was the hourly chart, right? I would say we're not trading this. We're not trading this. We're gonna wait for this, and you'll find that you'll get that every time. You just have to wait and be patient. Okay, that's the lesson. I know they kind of went for a bit of a detour there.